Hallelujah, the Bank of Canada has cut their key interest rate by 0.5%. Variable rate mortgage and home equity line of credit owners get some needed relief. But what does this cut signal, and how does it affect the average borrower, and where do we think rates are going in the future?
This is the Saskatchewan Real Estate Podcast.
So, the big announcement. The Bank of Canada made an important move by lowering its overnight rate to 3.75%. For those of you wondering why this matters, the overnight rate essentially influences the interest rates you get on things like mortgages, loans, and savings accounts. So why the cut? Inflation is cooling down, dropping to 1.6% in September, well within the Bank of Canada's target range of 1% to 3%. However, the bank is still concerned about sluggish economic growth and a soft labor market. They've shifted from raising rates to lowering them, hoping to stimulate growth while keeping inflation under control. For this next section, let's break down 5 key insights from this announcement that might impact you and the broader economy. The rate cut shows that the Bank of Canada is now more concerned with the economy's slower growth than with inflation. At this point, forecasts for GDP growth are modest at just 1.2% for 2024. This signals that the economy may struggle to gain momentum. For homeowners and buyers, this means more favorable mortgage rates, but the overall economy might still feel sluggish. Digging into this a little deeper and give it some perspective, think about the last time we saw rates like this, during the pandemic, when the economy was under intense pressure. The difference now is that inflation seems to be under control, but the bank is still stepping in to prevent the economy from stalling. For anyone looking to invest or buy a home, this could be the right time to take advantage of lower borrowing costs from now moving into next year. The labor market remains a challenge, especially for young people and newcomers to Canada. We're seeing an unemployment rate of 6.5%. And while the population is growing, hiring isn't keeping pace. This excess supply of labor creates a unique scenario. Businesses aren't hiring as quickly as they could, and that's holding back economic growth. This is particularly important for first-time home buyers, many of whom fall into the young and newcomer demographic. If you or someone you know is in this situation, the softer labor market could make it harder to qualify for larger loans and secure stable employment to meet mortgage requirements. However, the good news is that lower rates could make borrowing cheaper, which might offset some of these challenges. Depending on your current housing situation, you are either going to love or hate this next point. With lowering rates, the housing market is projected to pick up. Lower interest rates often lead to increased home buying activity, and we're already seeing strong demand for housing. Residential investment, including home sales and renovations, is expected to grow. If you are thinking about buying, the lowering of the rates could be an opportunity. Renovations are also going to become more affordable when borrowing costs drop. Keep an eye on housing prices, though. If demand picks up quickly, prices could rise in certain markets. It appears inflation is now closer to the bank's target range. Although shelter costs remain elevated, broader inflationary pressures have cooled off. Prices for many goods and services are stabilizing, meaning the worst of inflation is likely behind us. For homeowners, this brings some stability. You'll likely see less volatility in the cost of living, from groceries to gas prices. Even though shelter costs remain a concern, they're starting to ease, which is great news for anyone struggling with high rent or mortgage payments. GDP growth is expected to strengthen gradually, with forecasts of 1.2% for 2024 and 2.1% for 2025 and 2.3% for 2026. While these are modest numbers, they show a steady upward trend fueled by increased consumer spending and business investment. What's important here is the long-term view. If you're planning major investments, whether it's buying a home, starting a business, or renovating, the timing matters. The economy is set to recover slowly. Keep in mind that the reason the Bank of Canada made a jumbo 50 basis point cut is they do see weakness in the economy, and they're trying to soften that blow. Before we get to a prediction of where potential variable rates could be, let's quickly touch on how this recent drop will help current variable rate mortgage holders and how this cut will significantly keep more money in their pocket every month. With the recent cut, an average borrower would be saving around $29.50 for every $100,000 borrowed every month. This means that if a borrower had a $500,000 mortgage, they'll now have $147 less per month to service the mortgage. And that number could continue to drop as we move towards the end of the year. Based on today's announcement and the economic data, I expect we'll see at least one more rate cut by the end of the year at their December meeting. The Bank of Canada has indicated that they're open to more cuts if the economy continues along its current path. So why am I predicting another cut? Well, the Bank of Canada is closely watching inflation, which seems to be largely under control, and GDP growth, which is still slow. If unemployment remains high and growth doesn't pick up as fast as they hope, they'll need to lower rates again to keep the economy moving forward. The bank will be in a rate-cutting cycle until they determine they have reached a neutral rate. Hopefully for mortgage holders, that will be at least another couple cuts away. Before I let you go, don't miss out on the best real estate advice in Saskatchewan. Subscribe to the Saskatchewan Real Estate Podcast for the latest market trends, mortgage tips, and expert interviews that can help you make your next real estate decisions with more confidence. And don't forget also that I am a fully licensed mortgage broker and I want to help you take control of your mortgage renewal. Don't get locked into a higher rate. With my lender network and expertise, I'll help you find a lower rate, better terms, ensuring you save more money and have more flexibility in your payments. I also can help you with powerful mortgage strategies to save you thousands, potentially hundreds of thousands of dollars, and shave years off your loan. If this interests you, book a call with me today by clicking into the show notes of this episode. Until next week, I'm Ron Caroni, your Saskatchewan mortgage professional. Bye for now.